Let's talk about evaluating the earnings volatility crush. To begin with, assume that for the purposes of this video, all of our references to volatility will be regarding option implied volatility. Now let's define what we mean by implied volatility crush. As you probably noticed, implied volatility rises as moments of increased uncertainty approach. When those risks are resolved, or at least better understood, volatility expectations generally return to normal. This return, when it happens overnight, is what we mean by crush. When entering option positions during periods of increased risk, investors have to care about what the IV crush rate will be. This rate is measured as the percentage of volatility that the market expects to retain once a period of heightened risk is resolved. For example, let's say the implied volatility is currently 50, and the market is pricing it to return to 30 immediately following an earnings announcement. The crush rate would be calculated as 30 divided by 50, which is 60%. Here's an example using the 10-day implied volatility for the 10 days leading into an earnings announcement. As you can see, the volatility was trading at 44% prior to the after-hours announcement. It then closed the next day at 22%. We can calculate that this is an IV crush of 50% of its original value. If you back out to days further from the earnings announcement, you'll notice that the comparable crush rates are different since the volatility moved around quite a bit that week. Accurately modeling the magnitude of the earnings and volatility crush is a challenge, but the reward potential is substantial. This is where the Quantcha Earnings Crush Rate comes in. This is a proprietary metric we have developed to zero in on the market's expectation for the earnings crush for a stock. It's based on the current option pricing and implied volatility surface for that stock. It specifically extracts the expected crush rate for an at-the-money volatility for the option's expiration immediately following the earnings announcement. So let's unpack that a bit. Our crush rate involves two at-the-money implied volatilities for the same set of options, first expiring after the announcement. The first value is the implied volatility for those options right now. The second value is modeled based on how the market is currently pricing those same options for volatility on the first trading day after earnings are announced. We then divide the future modeled volatility by the current volatility to determine how much will be retained after the IV crush. So how do you use it? Well, it's actually really easy. Simply multiply the current volatility by the earnings crush rate. For example, if the first at-the-money options expiring after earnings are currently trading at a 40 volatility and the crush rate is 80%, then the market is expecting that the at-the-money implied volatility for that date to trade at 32 after the announcement. On the other hand, you may be interested in figuring out how much earnings premium is being applied to the volatility. This is just the inverse of the crush rate. If the crush rate is 80%, then the market is inflating the volatility by 25%. Now there are some really important things to point out before we move ahead. First, this metric offers no insight as to options expiring before earnings. They're not taken into account in any way. Second, the modeling is optimized for an at-the-money volatility. If you buy an at-the-money call before earnings and the stock moves at all, then your option won't be at the money anymore. While this rate can help you estimate the change in volatility, there are a lot of factors that will impact where you end up. Similarly, this rate is optimized for the first expiration immediately after the announcement. The farther you go out, the less accurate this rate will be for modeling. And finally, keep in mind that this is a calculation of market sentiment based on market data. The opportunity lies in the ability to discern when the market has mispriced the risk. However, sometimes the data might seem off. Sometimes it'll show a crush of over 100%. There are a few reasons this can happen. First, the accuracy of the crush rating is lower when earnings is far off. The pricing of options at 3 or 4 months out can have wide spreads and skew volatility. Another challenge is sourcing accurate earnings announcement data, especially for lightly followed stocks. To mitigate this, we supply the number of calendar and trading days between now and the announcement date that we're using to model against. We strongly suggest confirming earnings announcements before trading earnings, but you're going to do that anyway. We spend a lot of time integrating earnings considerations into our tools over at Quantcha.com. The first place you'll notice the earnings crush and other metrics is in our stock and trade screeners. You can easily filter and sort down to the stocks that meet your earnings requirements, such as distance to earnings and expected crush rate. Whether or not you filter on these metrics, you'll have them available to you in every result. You can then easily jump into the option search for a trade for your ideal stock. Or you can pass these settings into one of our trade screeners to filter and sort specific strategies. Note that the trade screeners also enable you to filter and sort your results down to only include trades that expire before or after the next earnings. You'll also see an earnings marker in each stock's term view. This marker makes it easy to see where each option expiration is relative to the next earnings announcement, as well as how various metrics stack up against it. Our trade analyzer also keeps you aware of the next earnings announcement date. Whether you have options expiring before or after earnings, the trade review lets you know exactly where it is so that you can plan accordingly. We've also integrated details about the next earnings announcement into the portfolio view. You'll be able to see the next expected date in line with your current holdings. If it's within a week, we'll print it in red to make it more obvious. We also offer our earnings crush and reference metrics as part of our data API. This includes over 4,000 optionable U.S. equities with history back to 2010. So to sum up, be sure to consider the implications volatility crush, especially around earnings, have on your trading strategies. And if you have any questions, please leave a comment below or hit us up at hello@Quantcha.com. As always, good luck and good hunting.